Now, let me talk about risk management. Very, very important. Okay, so again, whether you are going long, whether you're going short, if you want to make money consistently, you have to manage your risk. Okay, I always say that trading is risky, just like mountain climbing is risky, just like driving a car is risky, just like getting married is risky if you don't know what you're doing. But if you know what you're doing, then it is not risky in the right context. Okay, so here's how I manage my risk. So I always make money over time. I may not make money in every trade, but I always make money at the end of the month and the year. Why? Because I manage my risk. So here is how I manage risk. Number one, as a professional trader, you always risk a fixed percentage of your capital on any trade. Okay, and it has got to be a small percentage. So I always recommend that you should only risk anywhere between 1% to a maximum of 3% of your capital on any trade. If you risk more than 3% of your capital on any trade, I guarantee that you are not going to last very long. You are not a professional trader, you are a gambler, all right? So for this example, I'm going to take a 2% risk, okay? Now, again, you got to be consistent. Now, next, you have to know how to calculate the number of shares to buy and the number of shares to short in order to maintain your risk at 2% of your capital, okay? So this is the formula. The number of shares that you buy or sell equals to your percentage risk per trade multiplied by your capital divided by your risk per share. Okay, now let me explain what this means. Okay, now before I explain what this means, let me go back to this example which we went through earlier on. Okay, remember we saw this earlier on. Okay, so I'm going to do a quick review. Okay, so let's imagine you saw this crossover here. You decided to sell at 160, all right? You sell at 160. And you write the trend down. When you see the moving average 20 cross 40, you buy it back. Okay, sorry. Let me go through that step by step. Okay, first. Okay, so first you short sell at 160, right? So again, when you short sell, you're expecting it to go down, right? But what if it goes up? You lose money, right? So you must always have a protection. You must always have a stop loss. So if it goes up to a certain level, you have to stop and buy it back. So in this case, we decide to put our stop loss at 165, which is just above all the moving averages, because these moving averages act as a resistance. So it is unlikely the price can go above the moving average. Now, if it goes above the moving average, holy shit, you gotta get out. Okay, so we put our stop loss at 165. Now, so what is our risk per share? Our risk per share would be 165 minus 160. So our risk per share is $5. Do you follow that? So the worst that can happen is I will lose $5 per share if it goes up. Okay? Now, if it goes down, which I expect, and in this case it goes down and I buy back at 130, what's my profit per share? It's 130 minus 160, or rather 160 minus 130. My profit per share is $30. Okay? Now, I'll also teach you in the full training, how do you estimate how much profit you can make. It's not guessing. There is a way to estimate, and it's quite accurate. Okay? Now, anyway, so in this case, I'm risking $5 to make $30. So I'm risking 1 to make 6. Is that a good trade? Yes. I told you anything which is better than 1:2, that's a good trade. You can take it. All right? Now, remember I told you that you have to ensure that you only risk 2% of your capital. So if it goes up to here and hits your stop loss, it should only represent 2% of your capital. So how do you ensure of this? By knowing how many shares to buy, right? So we use that formula which I just talked about. Okay, so let's look at this formula in action right now, how it works. Okay, so again, number of shares you buy. Okay, what's the formula? Let me show it to you one more time in case you don't see it. You may want to write it down, in fact, very important. So the number of shares you buy would be your risk per trade times your capital divided by your risk per share. Okay, so what is the risk per trade? It will be 2%, as we have agreed upon just now. Okay, now multiply by your capital. Now this all depends on your capital, right? So let's imagine you have got $10,000 in capital to trade. So you will multiply 2% by 10,000, right? So that equals to what? That equals to $200. Okay, so in other words, if you have 10,000 in capital, you should not lose more than $200 on any trade. You understand? You cannot lose more than $200 on any trade. Why? Because that represents 2% of your capital. Got it? Okay, great. So, what is the risk per share you're taking? If you remember the chart I showed you, we are risking $5 per share, right? Every share you buy, you're risking $5. So, if you can risk a total of 200, how many shares do you buy, right? You take 200 divide by $5, which is the risk per share. Okay, let's take a look at it over here. There you go. You can see the risk per share is $5. Okay, so that gives us 40 shares. So now I know that, okay, I have to sell 40 shares of this stock or ETF. So what's my position size? My position size would be 40 shares times 160. Sorry, this is a typo. Let me just work on that. There's a typo over there. It should be 160. So that should be 6,000 if I'm not wrong. Let me just double check. Oops, no, 6,004. Okay, there you go. Okay, let me repeat that. Okay, so I sell $160, okay, times 40 shares, that's 6,004. Okay, so in other words, I will sell $6,400 worth of this ETF. Now, is this my risk? Is my risk 6,004? No. What's my risk? My risk is $200. Why? Because if the price hits the stop loss, I will sell at, or rather I will exit at 165. I will lose $5 times 40. That's $200. Okay, so I'm risking $200. That's the most I can lose. Okay, now if it goes down and I exit here, how much do I make? I make 6 times my risk. 6 times 200 is I make $1,200. Okay, and notice that $200 represents 2% of my capital. Okay, and 1,002 represents 6% of my capital. So that is how I manage my risk. So if you do this consistently, what do you expect? Okay, so let me give you an example. Now, on average, I do about 20 trades a month. Okay, I do about 20 trades a month on the US markets. But let's imagine you do 10 trades a month. Okay, and like I said, even if you use all the strategies, you can't be right all the time. Okay, you can't get it right all the time. That's a fact of life. So let's say conservatively, you can be right 60% of the time. So out of 10 trades, you win 6, you lose 4, right? So that means out of every 10 trades, you have 6 wins and 4 losses. Okay, but remember that each time you lose, you only lose 2% because we fix our stop loss and calculate the number of shares in such a way that we always lose 2%, guaranteed. Okay, and when we get our profit target, we always make double that or more. Okay, so at least 4% or more, right? Now let's give you a 4%. So which means that for the 4 losses, we will lose 8%. For the 6 wins, we will win 24%. Net, we make 16% return per month. All right. Now, what if your win rate is only 50%? You're right half the time. So if you're right half the time, and you get 5 wins and 5 losses, but each time you lose 2%. Right? And each time you win 4%. What's your net profit? That's still 10% a month. Okay? Now, what if you suck at trading? You suck at it, right? And for some reason, you're not doing well, and you are worse than random luck. You see, a stock has a 50-50 chance of going up or down, right? So even if you toss a coin, your chance of being right is 50% in the long run, right? But say that your luck is worse than random chance, and you are only right 40% of the time. So if you're right 40% of the time, right, for every 10 trades you're losing 4, you're making 6. Oh, sorry, you're making 4, you're losing 6. But each time you lose 2%. Each time you win 4%. Net, you still make 4% a month. And 4% a month times 12 months is 48% a year. Right? Isn't that better than fixed deposit? Isn't that better than CPF or anything like that? Right? So that's why I say that when you learn the right system, it is impossible to lose money. It's only how much you make. But you got to follow the system. That's a really important thing. Okay? Now, personally, it depends. I've got some accounts which I trade, I only risk 1%. Okay? So if you risk 1%, then of course the return is half. Some accounts I risk 3%, and I triple the return. It all depends, right? So when you can do this, you can get positive results almost every month, right? So let me just revise that with you guys. There are 2 ways to make money. You can either go long, buy low, sell high, or you can go short, sell high, buy low. Whatever it is, we don't care. We follow the trend, we make money. And that is how you make money consistently almost every month, almost every year. Okay? So this is 1 month of trading, one of my accounts, and you can see on an average month, it's about 13.43% return. Right? And this is only risking 1% of my capital. 1%, that's it. Okay? I'm a pretty conservative trader. This month was an 8% return. All right? And this was a 7.85% return. Okay? This was a 16% return. Okay? This was a sucky month. My win rate was only about 34%. Okay, for that month, I was having a really bad luck month, which does happen, right? So I only made 2.96%. Well, that's still better than fixed deposit. That's still better than CPF, right? It's not bad. So the point is, I always tell people, could you be financially free a lot faster than most people? Yeah, you can. All right. And what is financial freedom? Financial freedom is when your passive income exceeds your expenses, right? That means the profit from trading, the profit from investment, the profit from rentals is more than your expenses, all right? And how many of you would like to have that? How would you like to be financially free? All right, I see a lot of yeses, right? Good. Now, why? Now, understand that being financially free is not because you stop working, right? And I can tell you that when you are financially free, you still work. Like, I have been financially free since I was about 33 years old. Okay, I'm now 43. I've been financially free for 10 years, right? And I still work. I still do seminars, I write books, I travel around, I'm doing webinars, right? So people ask me, why? Why do you want to still work? Why don't you sit on the beach every day? Why don't you go shopping every day, right? Well, I did for a while. I got bloody bored, right? And you find that, when you eventually make all the money you can make and all the money you need, you have to do something meaningful with your life, right? And you find that the greatest joy you gain is really making a difference, whether in teaching or in charity or helping kids. And I do all three, right? So, and the great thing is when you're financially free, you still work, but you do what you love. You do what you enjoy, and you got no more stress. You're not afraid that the market's going to crash. Who cares if it crashes? I'm still going to make money. You don't care if you lose your income. You care if you lose your job, because your expenses are already covered. And any money you make from your job, from your business, is bonus. You can do charity, you can buy a new yacht, you can buy a new car. And that's the best part of my life. All right, and you can have that, right? You can have that. So how much time do you need to achieve that? It all depends on your expenses, right? So for example, if you spend 5,000 a month and you can get an average 5% a month in trading capital, which you saw is, I do, right? Then you just need 100,000 capital. 100,000, 5% a month is 5,000 a month. It covers your expenses. Now, of course, if you spend 10K a month, all right, then you need 200K in capital. Okay, so it really depends on how much you spend. Okay, now you may say, I don't have 100K now, I don't have 200K now. Yeah, but you can save up. So from now, learn the strategies, learn the skills, start saving up, compound your capital, compound until you reach 100K, 200K, you're financially free. You can still work, that's it. And some people ask me, Adam, how long must I take to master this skill? It really depends on individuals. I've got students who master it within 6 months. I've got students who master it within a year. I've got students who master it after 2 years. Okay, so it all depends on how many hours you want to put in, how hard you want to work. But the good news is once you master this skill, it doesn't take you much time anymore. Personally, as a professional trader, people are shocked to know that I spend less than an hour a day. In fact, nowadays, less than 30 minutes a day on trading, because everything is automated using my screening software, right? That's why the whole day I'm quite free, so I can spend time with my kids, I can do webinars, I write books, I speak, so I'll be bored to death, right? So if you're interested in that, it's something you can learn, right? It's definitely something you can learn. Okay, let me take a few more questions. I've got a lot of questions coming in, so I'm going to take it in a while. Give me a sec. But before that, I like you to understand something as a professional or a soon-to-be professional investor, right? There is no good or bad market. There's no such thing as a good or bad stock. All right. So people ask me at the beginning of the year, Adam, will this be a good year for the stock market? As I said, there's no such thing. If the stock market goes up and I'm long, it's a good market. If the stock market goes down and I'm short, it's also a good market, right? So remember, we profit as long as we follow the direction of the trend. And how do we determine the direction of the trend? By studying the price charts, the price patterns, and the fundamentals of the market. That's the key.